Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, November 24th, 2023. Hope everyone had a safe and enjoyable Thanksgiving with their family. Back on the grind this morning. So, as always, we'll start with our executive summary from today's Lit Off Morning Note. As always, if you want the analysis supporting these conclusions, as also as what to actually do about them in your portfolio, obviously need to be a client of 42 Macro. Starting with number one, upon today's refresh of our daily Bayesian research process, we discovered that Goldilocks is now the top-down market regime per our global macro risk matrix. Recall that Goldilocks is a risk-on regime in which investors are generally rewarded for increasing risk. That includes buying dips in risk assets and overweighting cyclical sectors and factors until the top-down market regime transitions to inflation or deflation, the two risk-off regimes in our grid process. Number two, with any phase transition in the top-down market regime, we must ask ourselves three questions. The first is, how sustainable is the new regime? To answer that question, we must first answer another question, which is what is driving the transition and how sustainable is that phenomenon or set of phenomena? And lastly, it's important to inquire which of our legacy positions are going to be most impacted by the regime change. And number three, the last question is easiest to answer. Whenever asset markets transition from a risk-off top-down market regime to a risk-on top-down market regime or vice versa, nearly every legacy position is impacted by the change. Refer to our discretionary investment ideas summary on page 6 for more details. Regarding the drivers of this transition, the primary factor we see is a breakout in global liquidity. Rather than unpack that dynamic in great detail today, we will refer you to our November 21st lead-off morning note. Regarding the sustainability of the breakout in global liquidity, we believe it can be sustained over the medium term given the recent directionally bearish volatility adjusted momentum signal phase transitions in key countercyclical drivers of global liquidity, such as the US dollar, bond market volatility, FX volatility, and crude oil. Refer to our November 22nd lead-off morning note for more details regarding these countercyclical drivers of global liquidity. Transitioning to my 42 macro dashboard here. So just reviewed the macro market indicators for this morning. Nothing overbought, oversold. So we'll just leave you with some levels for the S&P 500 this morning. So we got top side in terms of the long bow range at 46, 47, 46, 48. Downside's about 44, 1-2. Obviously, dips are to be bought in the context of the top-down market regime transition to Goldilocks. And then lastly, in wrapping up with a question from our 42 macro aware community here. We got a question regarding our positioning model from a client here. I'll just paraphrase the question here. So does quote unquote unlikely to find valuation support, which is something we have written in our quantitative risk management summary each day. U.S. equities are unlikely to find valuation support at the current levels. So the question is asking, does that imply a flat to down direction in U.S. equities on a 1 to 3 month time frame? And the answer is no. That particular statement, and more importantly, that particular model is not designed to forecast the direction of the equity market. Darius Dale forecasts the direction of the equity market, relying on the signals generated by the compendium of models that we employ on a daily basis in terms of our Bayesian research process, our positioning model being one of those models. So one of the components of the positioning model is our scoring of U.S. equity valuations on a percentile basis relative to their long-term time series, and also understanding the critical thresholds in terms of that long-term time series that have historically produced certain outcomes in asset markets. And that's where that initial statement was derived from, is understanding that, hey, with U.S. equities in terms of the price next 12-month earnings ratio being in the 75th to 80th percentile on a structural basis, on a long-term basis. I want to say there's about 30 or 40 years of data in that particular model. It does suggest that we are unlikely to find valuation support. You would expect to see U.S. equities somewhere in the, let's call it, first quartile or first third in terms of being able to find valuation support. Certainly not in the top quartile as they are currently. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, November 24th, 2023. Best of luck out there today. We'll catch you back here on Monday. Cheers.